Welcome all. My name is Paul Stockley, and I'm the co-head of oil and gas at Fieldfisher. And welcome to our ESG-focused webinar for energy and natural resources companies, with today's theme being extracting the right data to tell your ESG story and the communication of ESG strategies that are relevant to your business. A lot of webinar and other content right now is focused on COVID-19 and the business ramifications of that. We have deliberately chosen, in the main, to move off that topic for today's webinar. ESG, as a business opportunity and as a risk mitigation and PR tool for business, is here for the long term and will be a topic of growing importance well beyond the COVID-19 crisis, even though that feels very long-term in nature itself right now. Getting ESG right is a value driver, boosting long-term valuation of a company and lowering the cost of financing and operational costs. So it's about value creation, but also sustainability and resilience, each of which has never been more important than right now. We are joined today by a panel of experts from Buchanan, Standard & Poor's, and Plexus Energy, and I will introduce them in the order in which they will present. We have an hour set aside for this webinar, and we have 3 presentations as follows. First up will be Buchanan, who will give us an overview of the current state of play within the capital markets and the challenges and opportunities of ESG for investors and corporates alike. Then S&P Global will outline how they are responding to the ESG challenge through the production of reports, data, and insights to provide the information that stakeholders, investors, and the public are seeking or demanding. And then Plexus Energy, who will provide a practical view from the trenches perspective on ESG. They will look at the challenges that companies are facing and, drawing upon their experience, give a perspective on how they have seen the attitude of companies change in recent times. This webinar is intended to be interactive, so if you do have any questions or points you wish to make as we run through our presentations, you can use the questions function, and we'll aim to find an opportunity to address those points, either at the end of each presentation, if applicable, or at the end of the webinar. We have lots to pack in, but we hope you will find this session useful. In the interest of time, and without further ado, I would like to welcome Chris Judd. Chris is an associate partner and head of ESG at Buchanan. He joined Buchanan in 2016 with a broad corporate communications and investor relations background and a focus on sustainability communications. Prior to Buchanan, Chris worked for BP in their communications team, where his role included the management and development of BP's sustainability report and online communications. Over to you, Chris.
Thank you very much, Paul. Wonderful introduction. And thank you very much to the rest of the Fieldfisher team for hosting us today. So welcome, ladies and gentlemen. As Paul outlined, Buchanan is very much involved in the investor communications support of corporate clients listed on London Stock Exchange and other exchanges. And obviously, to date, we are obviously getting far more involved with the ESG requirements of organizations and the expectations that come with their communication online and to the investment community more broadly. So where are we today? Paul, if we can slide through to where are we today? So ESG is mainstreaming in a very big way. That's very evident from what we're seeing, not only in the media alone, but also in the growth of the number of funds that have either got an ESG mandate to them or that are increasingly placing an ESG screen across them. Importantly, ESG is asset agnostic, so it's very, very much applicable to the natural resources space, as we will go on to talk to. And obviously, in part of this growing push from the investment side, we are seeing a far greater uptake in the application of the UN's Principles for Responsible Investing, as we've seen here in this slide. And the application of the 6 principles with which they help shape their approach to ESG screening and obviously how they're helping to evolve the investment community more broadly adopt these practices. But with all of this, there is increasing tension within the system, the investment system, placed between corporate disclosure, so what the corporates are disclosing from an ESG perspective, be it the rhetoric or the data that they're providing, and then on the flip side, what investors are required and what they're requiring to make informed investment decisions. That are helping them move with this agenda and moving it forward. So on to the next slide, the investor perspective. So, ESG is not a new phenomenon, despite it mainstreaming at present. And it's very clear that there are many opportunities available to the investment community with regards to identifying ESG risks and opportunities in the profiles of the businesses with which they're screening. And from a natural resources perspective, that is very evident from where they are in the development cycle. And obviously it's incredibly important that their profile is very clear. From a preparedness perspective, this is talking specifically beyond compliance now. And investors are seeking robust policies and systems.
Please, this is not the time, Catherine.
Sorry about that. Where I was saying, where it was once compliant, there's now the opportunity for companies to promote their opportunity relative to peers on ESG issues. And identifying very, very relevant performance metrics is obviously key to them. But on the flip side, there are lots of challenges from the investment community in terms of understanding what is most relevant to them. And some of the issues that are being identified to date are the consistency or inconsistency of data disclosure, be it from one corporate year to year, or be that in some instances, or be that when trying to draw a comparison between peer groups, and be that on environmental or social issues. And equally, more often than not, sustainability disclosure has been, on the whole, completed on an annual basis. So where you're getting quarterly updates from the investment community, from the corporates on operational and financial updates, the lack of this data on a more regular basis is obviously making it more challenging to channel that into how this should be thought about on a more consistent basis. Similarly, the differing data calculation methodologies that are used, providing out of kilter abilities to actually screen and analyze the data when set against peer groups is proving challenging. And I think finally here, and this is, it's crucial that with all of this that engagement is maintained, that the differing ratings agency methodologies, you need to understand where they're coming from and what it is that you as an investor are trying to achieve. Because obviously they're taking different approaches, whether it is based on the profile and the preparedness of the business, or whether it is on the impact that the business is hoping to have from a broad perspective. Onto the industry perspective, I think it's fair to say that the natural resources sector is probably ahead of the curve and has been ahead of the curve because we have been front and center in many ways. Our footprint is obviously quite heavy from an environmental and increasingly so from a social perspective, as well as the events that precede us, which we don't need to go into detail at present. But it's super important that we do engage and we continue to engage on this. And some investors are obviously going to look at this from an impact perspective and looking at businesses focused on environment, on electric vehicle metals. And there is that end of the spectrum, but at the flip end, there's obviously ESG is applicable to everybody, and obviously we need to remain involved and engaged in that. And so stakeholder-driven disclosure, it's been voluntary. The business, natural resources sector has taken this forward over the last 20, 25 years or so, and really owned it. And they've done it individually, and they've done it as part of industry bodies and standards, some of which I have listed here below, like the likes of Brindex and IPECA in the oil and gas space, and then ICMM and IRMA on the mining side. And these are important. Engagement thus far with certain CEOs on these. Some data sets for the oil and gas sector don't quite make sense in their most blunt form. And they are regulatory mandated, some of the climate disclosures, for example. But it's through the engagement of CEOs, through these associations, that we are going to be able to help bring much more focus to what really is important to the industry, and how that's going to be useful and relevant and integrated into investment thinking. And similarly, on the mining side with IRMA, this is a very interesting association, in that it doesn't just focus on the mining operators themselves. The likes of BMW are involved as well, and people throughout the value chain. And that's also going to be super important as people get to grips with and seek to have a better understanding of how the mining industry and the entire supply chain come together. Because obviously, the commodities that the industries produce are going into many, many different spheres. And as this greater alignment is brought together under these associations, so this is going to help benefit the investment community. One, in terms of the standardization of metrics and standardization of what policies should be in place. And all of this is certainly working in our favour. So on to the next slide, owning your own data story. Now, this is important because I think it's very clear that there are lots of multiple data sets from an environmental and social standpoint that businesses can apply. And it's important that you contextualize it as to maybe where you are in your development cycle. Obviously, if you are early stage exploration or early into your development cycle, your environmental footprint is going to be incredibly different to that as an operator. So the likes of Danakali or Highfield Resources, both in the potash space, have spent a lot of time focusing on correctly identifying what social metrics and social programs they require to make sure that they're delivering on exactly what it is that they want to achieve, that helps them get through the permitting stage and on to developing the assets that they found. And equally, it's important to contextualize the jurisdictional risk, because the above ground risk is vitally important to understanding how you necessarily negotiating with the regulators, or whether it is different communities. I think we're all cognizant of that. Similarly, identifying the right KPIs from a safety perspective might depend on your mining methods, and so everything needs to be given that context. Why the management team, when you're using that in your investor communications, why you've identified that as being super important to you, what it is that is driving your focus and investment in that, and obviously, and hopefully, what benefits you're extracting, be that cost or be that greater asset utilization rates. Onto leading and lagging indicators. Again, I think it's important that you bring a lot more focus into what your inputs are, be they training on ABC, for example, and how and why they're important to the business. And then obviously the extraction should be hopefully no non-compliant events, which again impact reputation risk, can impact cost of capital, can impact it can fold into litigation costs and what have you. So again, by weaving this entire narrative together from what you're putting into your own internal system and what you're extracting out is super important. And doing so, you need to disclose the methodologies, because I think as big aggregators are pulling this information together, it's vitally important they understand how and why you have interpreted the information that you have, because this is one of the key cruxes that we find ourselves in at present. And then obviously, as I previously mentioned, the incorporation of this information into your capital markets communications on a more regular basis is super important. People need to fully appreciate what is front and center to you as a management team from the very off. And as I say, where you are in your development cycle will ultimately depend what KPIs are most relevant to you going into the business, and obviously extracting them as well. So where is this all going? From the investment community perspective, I think it's plain to see, based on all the evidence we're seeing to date, both in the media and just the increasing pools of capital that have been drawn together, that the direction of travel is that ESG is not going away. It's not abating in any way, and that it is very much here to stay, and therefore it must be engaged with. Equally, there's a lot of harmonization required. It would appear to be that banks are in some respects are being asked, and there's certainly been more emphasis placed on them to help bring together more standardization of what is important from an ESG standpoint, and be that for the mining and oil and gas space, or more broadly across all asset classes. A good case in point would be the Investor Alliance for Human Rights, where we've got LNG, Hermes, Aviva, BMO, along with a whole host of other asset managers, looking for governments, calling on governments to pull together regulatory measures on human rights risk management, which is obviously super important, and obviously where the likes of a Fieldfisher will come in and help them make sure that they're providing appropriate guidance to their corporate clients. Equally, internal framework development, as the investment community appears to be coming up the curve, employing more intellectual capital into their business with regards to ESG and sustainability expertise, they're going to be developing their own strategies, be that negative or positive screening, and how they are going to obviously fold that into their approach. From a corporate perspective, we are in an age of big data, and I suppose the expectation that businesses continue to invest in their systems and capture more data across their entire bandwidth, from environmental, social, and governance, is super important. But equally, target setting. I think as guidance is provided to financial and operational metrics, so that expectation that it will be given the guidance to a degree, and certainly target setting will be expected of businesses as they seek to manage down these risks, and that all needs to be encapsulated within a strategic, an ESG strategic narrative. Again, greater alignment with industry standards, as I previously mentioned. These bodies have been very important in the development of frameworks that corporates have adopted well before ESG has mainstreamed as much as it has, but equally they are going to continue to support that, not only the education of the markets more broadly, but I think they're going to be instrumental in driving more consistency across data sets and how they're applied. Regulation is obviously coming as well, increased education, as data sets are being relied on more and more to make investment decisions, and with the likes of sort of banks like Barclays and Berenberg that are using ESG data now to almost provide value and seeking, Barclays in this instance, seeking to provide adjusted valuations for from a sell side perspective based on ESG data. I suspect that verification is going to become far more important. So the earlier engagement with that from a corporate perspective, I think, is certainly going to be key. And then ratings agencies, these guys have been around for a long time, are very, very well engaged in this process, and are providing very clever and sophisticated investment products that are helping at both ends. They're obviously helping with the corporate shape what it is that they need to be providing, and equally making that digestible in many respects for the investment community. But ultimately, the ubiquity of ESG mandates from the investment community and that growing case, that growing sense of it, means that corporates are going to have to continue very much engaging with this subject and doing so in an authentic and transparent manner as best as possible. And making sure that what it is that they're capturing from a data and information perspective is truly reflective of that business and the material issues that it needs to address, and not just trying to box tick and check everything and ultimately fall foul of potentially being perceived as greenwashing. And without further ado, I will take any questions now, or certainly hand back to Paul.
Many thanks, Chris. That was great. We have actually, I can see one question that's come in already, but I think it could apply equally to us all later in the panel. So I'll leave that for now and move swiftly on to our next presentation, which is from S&P Global. We have a double act from Lynn Maxwell and Roman Kramachuk. And just by way of introductions to those two, Lynn leads the business development and relationship management functions across all sectors in EMEA and develops commercial and marketing strategies for new and existing products. Before joining S&P, Lynn was HSBC's head of global strategy in the structured finance group, and prior to that, co-head of flows securitization at BNP Paribas in London. Roman leads the efforts at Platts to analyse the impacts of the energy transition on the energy sector and market outlooks, with a special focus on clean energy. He oversees the Platts Analytics Scenario Planning Service, advising clients on long-term energy market views, including 2-degree scenarios, and offering insights into environmental markets and policies. Prior to this, he was at the US Environmental Protection Agency, developing key power plants and industrial emissions regulations at the Clean Air Markets Division. So thank you both, and I'll just try and move the slides on.
Great. Thank you very much. Hello, everybody, and I hope you're having a good afternoon. Together with my colleagues, I'm going to ask Jacqueline Bouchard from my team as well to speak to you. And Roman from our sister division Platts. Today we're going to outline for you how we work with energy and natural resources companies to support their ESG transition through analysis and data. Paul, we can move to the first slide. As you all know, S&P Ratings provides visibility to the market on the credit profile of a company. Investors expect that company's credit profile today to include ESG. So we do include ESG factors in our ratings analysis. More recently, we've addressed investors' demand for a deep dive into ESG of a company by developing the Esg Evaluation. This is where we look extensively at the E, the S, and the G of a company. And it's a scoring which is supported by a lengthy, detailed report that the company can then share with its stakeholders. It can share it publicly, it can keep it private, but generally we find that our customers want to share it with investors and other stakeholders. So the ESG evaluation for us is a natural step in our journey of providing ESG analysis and data to the market. It's what we like to call the Esg Data Factory, as we've noted on this slide. So 20 years ago, our sister division, Dow Jones Indices, launched the first Sustainable Finance Index, the DJSI, and that remains a key index for ESG achievement even today. We've since then invested in a number of sustainable data providers, most recently in an acquisition of RobecoSAM, or SAM as we call it, a leading ESG data company and scorer. Previously we invested in TrueCost, which is a sustainability specialist. So for this particular audience, though, we thought that we should discuss how ESG transparency can assist the energy and the natural resources sector. As you know, your industries have particular challenges and issues around investor perception. But equally, you are making progress and you're investing in new technologies. So it's important to have a way to communicate this, as Chris has said, and we'll focus on how you can communicate that to investors. It's really important because if you're not telling your story or if you're not telling it well, the default assumption by investors is that you're not doing much at all. And in that case, investors will have to turn to assessments which are based on incomplete public information. And we wanted to highlight, just as Chris has said, that ESG investors and funds are a really important investor group for you to tap into. So ESG investment is growing, as he showed in his slides, but also more recently, we've seen net inflows into ESG funds, while other funds are experiencing significant outflows. Also, we've seen that 13 ESG funds have outperformed the S&P 500 over the past few months. So it's a really important investor group to be aware of and to be working with. So what do investors need from the resources sector? First, they really need a company to clearly identify its material ESG issues and to describe its strategy so that, to describe how it's managing those issues. That can be done with the support of legal advisors and other specialist advisors like S&P's TrueCost. Secondly, they need the message to be delivered clearly, and that has to be not by looking backwards at the backward-looking analysis, but through an assessment of what the company is doing today and how prepared it is for the future. Looking at things like what environmental impact reduction strategies have you implemented? What clean product innovation are you testing to uncover new revenue streams? In the ESG evaluation that we share, and we can turn to the next page, Paul, this one on Repsol, you can see that we do a deep dive analysis that takes consideration of how Repsol is prepared for the future. So specifically, and before I turn over to Judd, what companies want from the ESG evaluation is that they really want an analysis that combines sustainable expertise and sector expertise. So S&P's credit analysts have, for example, oil and gas sector expertise, which they combine now with sustainability, and that gives a specific knowledge about the sector and company peers and ESG. Also, a company that wants to share what they're doing to transition in the brown industries, they want to be able to tell about their R&D and their strategy. So that comes best from an engagement with an ESG evaluator. You can share things through interviews with the management and the rating agency, as opposed to relying just on publicly available data. And our ESG evaluation brings into consideration a preparedness score based on that privately shared information. Finally, investors want to see an ESG analysis that's being done by a reputable organization with independent analysts, which is why S&P, as a regulated rating agency, has been set up to do ESG evaluations. I'm going to pass over to Jacqueline to take you through the Repsol evaluation.
Great, thank you, Lynn. So on the screen, you'll see a snapshot of the ESG evaluation for the Spanish oil and gas company Repsol. So Repsol and other companies saw the benefit of the ESG evaluation, as Lynn mentioned, because it's a process that utilizes our analysts' deep sector expertise, in-depth direct engagement with management within the company, from senior management all the way up to the board, to be able to tell their transition story, but not only just tell it, to also provide trust in it through an independent opinion. So our analysts first build out the ESG profile, which is the first part of the report, and this is based on public and private information on their financially material key performance indicators for ESG. And so on the slide, you'll see the profile score, and the blue bar represents that sector. You can think of it as the floor to ceiling, and then how that company performs. And so this provides the groundwork to begin their analysis on the preparedness opinion, or the forward-looking view of the company's ability to operate successfully in the future based on their awareness of and preparedness for these future risks and opportunities. This comes from the in-depth senior management and board meetings. This is the section which investors are most interested in, I think companies are most interested in as well, and which really sets the product apart. This engagement and output opinion allows companies to differentiate themselves and clearly articulate their strategies to mitigate risk and seize opportunity. As Lynn mentioned, this could be minimizing energy use to avoid future rising energy costs, or diversifying into cleaner product solutions for new revenue streams. The preparedness opinion provides insight into a company's strategy and the way it seeks to position itself over the long term to provide long-term value for investors. So it's almost like a way to break out of the standard ESG KPI framework and truly tell a holistic story that looks forward into the future. And you can see on this Repsol report that this preparedness opinion, they got a very good score on it. And so it uplifts their profile from a 61 to a 68 for that final output score. And so we can go to the next slide. One great use case we want to share before turning it over to our colleague Roman is that the company MassMobile, they use their ESG evaluation score as the KPI for a sustainability linked loan and the initial reference point for determining changes in the interest rate on both the CapEx line of credit and the RCF. They trusted the ESG evaluation as their KPI of choice because they recognize the need for a score that is based on in-depth engagement analysis with the same rigor that is applied to a credit rating process, such as transparency of methodology and direct engagement between company and analyst, which is one of the ESG evaluation offers. They can also be sure that methodology will not change at the drop of a dime and that it is pretty steady and transparent over the long term. And so with that, I will pass it over to our colleague Roman from Platts.
Thank you, Jacqueline. Thank you, Lynn. I think most of the folks in the extractive industries are familiar with Platts as a company that really provides insights both into the outlooks on the energy sector, but also in terms of the pricing and transparency around it. What we do is really help companies. When we work with companies, we work around the energy transition topic. So we really focus on the E part of it, and we really focus on developing a capacity around developing a preparedness plan. I like to put up this chart as a starting point for conversation, just because this shows where we are now. And this reflects, this is actually all of our internal data across the commodities. It shows our views of where the energy is coming from, how it's being transformed in the middle. You can see refining, power sector, and ultimately the end uses on the right. And we have these sort of diagrams with the different scenarios we develop that show the implications for these different sectors. We have underlying data that shows our outlooks, and ultimately we have a global world energy demand model that covers 143 countries, 9 end-use sectors, and 20-something commodities in the energy space. So we have this level of granularity that we work with companies to help understand the implications for their business and understand how they can both address the risks and develop the opportunities that they see in this space. So I think the key thing to remember about this chart as it currently stands is that this snapshot of 2020, and granted 2020 is going to have lower emissions because of COVID, and we've done estimates around that as well. But even so, we're talking about over 30 gigatons of emissions, of CO2 emissions. And this is while under a long-term Paris Agreement target, we need to get below 10 gigatons. So we need to get this more than 1/3 of, we need to see changes that knock out the fossil fuels, which account for 80% of the total. And that obviously has, if that is the trajectory we're going on, if we're going on a 2-degree and below trajectory, this has major implications for both risks and opportunities. So if we can go to the next slide. And just if we can just click through, I had said some of the animations here. I think this really highlights, and we go by sector, looking at, for example, passenger cars. What this reflects our deep electrification sector. So it represents both the risks and opportunities for passenger cars. To get down to that level of emissions in passenger cars and commercial road transport, one needs to reduce their usage or really improve the efficiency of their usage of gasoline and diesel. And what that does imply is either an uptake of electric vehicles, which has implications for battery metals, or it involves the implications for hydrogen. And this is where the other parts of Platts play a key role, because we do offer price assessments. We've rolled out price assessments for hydrogen. we have price assessments for battery metals such as lithium and cobalt. And that allows companies to actually look at the pricing and figure out their strategies. You can see also across the different sectors, some are more challenging and some are more difficult to actually decarbonize than others. And these are the sort of interactions that we have with companies in helping them develop their strategies and improve their preparedness. So if we can click through to the next slide, please. I think, yeah, and actually let's just halt there. If we can go back there, at the bottom of that prior slide, you can see our assumptions of the approaches and the technologies, and this is part of the signposts and the pathways that we do spend time working with our companies and trying to understand. Obviously, there are certain sectors and certain technologies that we've identified as really the likely transformative technologies. Among those are power storage, battery power storage. Among those are hydrogen. Among those are electric vehicles. Among those are PV and wind. So these are all factors that we are looking at, and we provide deep dives to really help understand both the risks and the opportunities in this space. So, and I think behind this is also, we talk about how we look and help. We have asset level databases across the energy sector. So for instance, we have a industry leading world refinery database, which we're working to add attributes to, environmental and other attributes to. We have a world oil supply model that goes field by field, and also we're looking to add environmental attributes to understand how those either refineries or how those fields will be responding to the scenarios that we lay out, and how they will be responding to their direct emissions. So these are all factors that we're building onto our views, building onto our data on the underlying assets. And I do also want to, most of you are probably most familiar with Platts in terms of as a price reporting agency. And I mentioned some of the price assessments around hydrogen, around battery metals. And our most recent effort is actually some price assessments, developing price assessments around responsible natural gas, and developing a metric by which responsible natural gas can be priced separately and can be part of company strategies to actually show preparedness and be ready to respond to energy transition challenges. So I guess I can close with that, but ultimately the way we work is we really leverage our deep understanding of the energy sector. We've been doing this work and we understand oil, we understand gas, we understand metals, we understand the commodity space, we understand coal, and the risks and opportunities across that space. And by leveraging our understanding of transformative technologies, of the underlying policies, we can help develop this sort of strategy that can really up that preparedness score and help companies get ready for what is obviously there. Some companies are in the middle of this already in places like Europe, others are preparing for it, and this is what we're part of providing. So with that, I can pass this on to the next speaker.
Many thanks to our S&P team. I'm just looking at our time, we're handing over next to Plexus Energy. We have about 22 minutes left in our time. So without further ado, I will just quickly introduce Jay. So Jay Wagner is the director and founder of Plexus Energy. Plexus is a London-based ESG-focused consultancy, and Jay has 30 years experience providing advisory services to private and public sector clients in the mining, oil and gas, infrastructure and financial sectors. He develops and implements policy for high-profile projects and advises on environmental and social risk management in OECD countries and emerging markets, with a focus on the social, environmental and economic aspects of investment decisions. So I'll just try and move on to your slides, Jay, and then over to you.
Thank you. Good afternoon, everybody. Right, so building on what my colleagues have just been saying, I'm going to be offering you a sort of a view from the project level and how we see things, with a particular emphasis on the S in the ESG setting. So we're going to look at the project setting. If you could move to the next slide, please. So first of all, I'd like to emphasize that a lot of progress has been made in the last 15, 20 years, particularly with the introduction of project finance standards by the International Finance Corporation and the Equator Principles. There's much more emphasis on transparency and improved performance, arguably that wouldn't have been there had it not been for these standards. But I think it's equally important to remind oneself that there are some challenges. The ESG reporting sector, as we've just heard, are doing very important work to try and help investors make informed decisions on these things. But it is difficult to get a good picture. As was said before, you do need to do these deep dives if you really want to get to this. This has to be done oftentimes on a sort of risk basis, recognizing that most of the ESG kind of issues and impacts do happen at the project level. So we have to ask ourselves, therefore, what are we reporting on? Why are we reporting on it? Whom are we targeting? And in particular, to link ESG reporting to the actual risks that we see unfolding. If you can move on to the next slide, please. So there's a risk both at project level and further up the food chain, if you like, of what I call flying blind. Although, as I said before, a lot of progress has been made and many companies are really trying to do a good job and putting good impact studies, environmental social impact studies together, there are still a surprising number of them that don't. Baseline studies are put together that are mere data dumps and compilations of data, and they don't really use this information effectively to drive and to the conclusions that they make and marshal this information. So there are challenges at that level. Many companies or projects don't really know their stakeholders, that is, stakeholders in the catchment and the areas of influence where they're operating. We see this also at the social level, that the metrics and the indicators sometimes are flawed and are not thought through in relation to the risk profile of the project. What also often happens is that contextual risks can be overlooked. And this can happen to all sorts of organizations. It happened to the World Bank a few years ago in a large infrastructure development project in Uganda, where ultimately, after a complaint was brought and it was elevated to the World Bank inspection panel, the World Bank, faced with the social issues that had occurred there in relation to migrant workers, decided to cancel this project. So it can happen to a number of different organizations. The other issue is what I call the good news bias, that a lot of clients oftentimes don't want to hear really the difficult news. They're under pressure to get projects off the ground. And you show both investors and consultants who come to look at the projects, but it's the kind of Potemkin village syndrome. You show them what you want them to see. So there are some inherent limitations to the environmental social due diligence process. As I said, this doesn't mean it happens across the board, no, but there are a number of cases where this has happened and led to poorly informed decisions. So project management, of course, is risk averse, but it's just to be aware of that potential limitation. Next slide, please. As I said before, with the involvement of project finance providers in Equator Principal banks, we've seen a lot of progress being made. But equally, the flip side of the coin is you can get a false sense of security. There is what I call the obsolescing bargain. As you are financing and dispersing funds to projects and companies, the power relationship changes over time, and your influence over the project lessens over that time. That is not to say there are many projects where the banks have stayed the course, carefully monitoring it. They're there for the life of the loan, and they've managed to push the dial in the right direction. But there are equally many examples where that hasn't happened. Banks often want to move on to the next project and perhaps don't monitor as closely as they might. The independent environmental social consultants who are tasked with helping the banks in monitoring don't always do as good a job as they might. For a variety of reasons. Sometimes it's reluctance to speak truth to power. Sometimes it's just they're not up to the task. There are a variety of reasons, but it's just being aware of some of these limitations. Projects themselves also face what I call the expectations traps, particularly in some regions of the world, Middle East, North Africa, and Central Asia, where you have very high expectations by host governments, say for social projects. And remember that many of these projects, the impacts tend to manifest long before the benefits flow. But in this case, projects hand over sometimes tens of millions of dollars a year on social projects, but not necessarily paying that close attention to the outcomes of these projects. So they provide a good photo opportunity, they get reported on in the sustainability reports, but we don't necessarily know what the outcome is and have they actually helped to improve the lot of the beneficiaries. So just a cautionary note on that level. If we can move on to the next slide. As I said, there are certain pinch points in the developments of projects, particularly during the construction stage. And I mentioned this because it is at the development and construction stage where many of the most significant impacts, social and environmental and otherwise, do tend to occur. The influence we have to change them, to influence them, diminishes over time as the costs increase as we move through the different stages of the project. So it's just to remind ourselves that there is that dimension of the projects as well. Next slide, please. In other words, there is at times a risk of a bit of a disconnect between the corporate level, headquarters focus, and what's happening at project level. As we've heard, of course, we're talking about different audiences with different focuses. So you cannot do this on all projects, of course, but we have to be aware that the availability of good environmental and particularly social information and data isn't always there, particularly during the construction phase. Budgets are tight, particularly pre-FID, and projects will themselves get mixed messages from above. They have multiple audiences to deal with. They have to deal with headquarters. They have to make sure that they keep on schedule and on budget. They have, of course, host government expectations to live up to, and not least, local communities. An example of a few years ago with a major oil and gas company doing an impact assessment in Nigeria. Corporate communications for the sustainability report was keen to tell a good news story on how this impact assessment was unfolding. The project told the headquarters, not yet, this is not ready yet. They went ahead with it anyway. When an NGO investigated this good news story actually didn't stack up, and they got egg on their face. So there sometimes can be tensions along in that respect as well. Next slide, please. You have different challenges with small cap companies, particularly in the mining sector. They have almost by definition oftentimes a more short-term time horizon compared to a long-term operator perspective. The IFC have been trying through their early equity strategy to address that with mixed results. But it's just to be aware that the challenges, it's not just the large complex projects, it's also smaller companies that face this. Here you have to ask yourself what you're going to report, at what stage, very, very important. You can get false sense of security if you have, say, an IFC compliant grievance mechanism in place, or a good stakeholder engagement plan. On paper it looks good, but how these things are actually lived and applied and socialized on the ground is oftentimes quite different, and you can get a very different perspective if you do that deep dive. Next slide, please. So there is a growing social conflict potential we see in many sectors, whether it's energy, oil and gas, or mining. When these things happen, they really can hold up projects. In some cases, even stop them in their tracks. If you can just click one more time, please. Or, as I said, lead to the outright cancellation of projects. If we go to the next slide. So some academics in Australia, looking predominantly at the mining sector, they sampled several hundred mining projects, both large and small, around the world, because they were trying to get a handle on what is the cost of this social conflict, and how it is beginning to show up on the balance sheet in many projects. What they found of the sample that they looked at, that some 90% had delayed submissions to government due to this. Demonstrations of one type or another against the company or the project was 80% of the sample faced that. Litigation risks go up to 50%. Blockades, very, very frequent occurrence. Fatalities sadly happen as well, particularly where security forces are involved. So there is this reality to be aware of as well. This comes under the umbrella, if you like, of contextual risk. If we move on to the next slide, please. No, one back. So just to wrap up then, conscious of time, I think the performance standards and the emphasis on ESG reporting has had a very positive impact. It's a journey we're all on, and it's still a way to travel. There is a value in transparency. We need to make informed investment decisions, but we also need to remind ourselves there is the disconnect. Can you go back? There's a disconnect, sorry. There's a disconnect between the corporate level reporting and project level ESG issues. There's insufficient accounting for, arguably, for contextual risk. There's a lack of focus on outcomes, particularly when it comes to social and community development. And there's also a question around the data. We need meaningful data. We need meaningful metrics and indicators. To use the analogy, if we're going to count trees, we need to know which trees to count, when and how to count them. And ultimately, we need to really emphasize the monitoring aspects. We need to verify the claims that are made and understand the project realities. Last slide, please. And just sort of to look a little bit to the future, I think, as the previous speaker said, ESG is here to stay. I think societal expectations are driving this change and will continue to do so, and there will be more scrutiny from stakeholders. We were not supposed to mention COVID, but I will anyway. Where are we going to go from here is anybody's guess. Are we going to go down the route of building back better? I think there should be more emphasis on the energy transition agenda, but the outcome of the pandemic and the impact of that on this is as yet unclear. I do think that there will be project finance implications. Project finance providers are becoming more conservative and more concerned about these things. If you like, climate proofing their standards, many of them are beginning to do that. We're likely to see more migration pressures, in-migration and so on, increased social conflict potential, particularly in regions like Africa and Latin America. So in other words, the need for good ESG reporting is likely to become more important as we go into the future. We need to ensure that this reporting links to the true and emerging risk picture that we're seeing. We have to focus on this disconnect between corporate and project levels, focus on the contextual risk element, and develop suitable metrics and indicators to address this. Thank you very much.
Thank you, Jay. And apologies for the issues with your slides there. That's entirely my fault, as I was trying to multitask while seeing the questions that were coming in. Just looking at the time we have, in order to keep on our time, we have 7 minutes, and we've got a couple of questions that have come in. So perhaps I can put to the panel these questions, and then I think if any panelist wishes to respond to the questions, maybe obviously put yourself on microphone, but also on video, so that we can see you. So the first question is, understanding that one size does not fit all, are there any suggested ESG standards for extractive companies to work towards in the coming years to attract investments?
Hi, Paul. I can kick that off and then pass it over to Chris. I believe he said he has something to add as well.
Thanks, Jacqueline.
Sure. So in terms of standards, thinking through what a company can set as an internal standard, but also a standard to report to, we can reference back to what my colleague Lynn said in our recent acquisition of SAM, the ESG business. They have very specific, very sector-specific sets of ESG data KPIs that are financially material and what companies should be considering when they are assessing their own performance, and obviously reporting that out to investors because it needs to make sense and align with the operations of the business. And so these sets of ESG KPIs have been built in-house by an investor over 20 years, so built by an investor for investors purely to overlay in their own investment decisions. Therefore, we're very excited to have that now in-house, but taking a look at the KPIs and the data in there, you can tell that it is definitely the most in-depth assessment of these KPIs or list of KPIs. And if a company were to look at those, I think they'd be on a great path to understanding what they should be considering, tracking, and reporting out. And then just taking one step further in total agreement with, you know, even the best set of questions or data KPIs never captures the full story. And that is especially the case with these industries where strategies and forward-looking views need to be very specialized and tailored to that company's needs. We think that's where our ESG evaluation really gets to, because that qualitative analysis and that direct engagement allows you to just kind of tell the story, and then that opinion and output report can provide, you know, kind of takes off the barrier or the fencing around what might be E, S, and G, and allows you to tell a strategy through that is material to your company, and, you know, can kind of incorporate however you see fit.
Great, thanks, Jacqueline. And I might just add that maybe something that's maybe a wee bit more focused, obviously trying to tackle the climate change debate and agenda, are obviously the TCFDs and how business is beginning to approach those. The initiative led by Mark Carney, you know, setting out what your governance structure is, your risk management processes, the strategy with which the business is going to tackle climate change. And obviously the KPIs that are set. This is an initiative that transcends the natural resources space and other asset classes. And I think it's going to be incredibly valuable in drawing alignment across all sectors about how businesses are tackling this issue as we transition to a lower carbon future. And I think that's one that businesses should certainly be looking and focusing upon.
And I just wanted to highlight, to reinforce what was just said about the TCFDs, because there is a clear need for, I think a lot of companies are going through this process. You know, S&P Global went through this process recently and developing their approaches to how they're handling this. And part of it is really understanding the scenarios, and that's some place where we're working across to also help companies define the scenarios by which they then measure their and report their TCFD.
Great. Thanks, Raymond. Thanks all. I'm very conscious of time, and so we should clearly have allocated more time. But in the interest of keeping to time, there's one more question I'd just like to put to our panel, and that is, how confident are the panelists that the ESG reporting reflects the reality on the ground? So anyone who wants to take that?
I don't mind taking that one to begin with. I mean, the strategic reports within which a lot of information is disclosed is a regulatory requirement, and so, you know, management and boards must sign these off. So they have to. There has to be a strong alignment between them. Otherwise, you know, obviously they get found out, and the reputational risks that fall out of that, as such that they may never return. I think we've seen that with the likes of Afrin winning corporate governance awards in the past, and then obviously what happened there. So I think they do try to reflect they have to reflect the reality on the ground. Certainly where we have been able to cherry pick, shall we say, some data metrics and obviously the stories, there's certainly more expectation now from not only the investment community but broader stakeholders that you are transparent with the issues that you're having to contend with on the ground, that you do talk to any environmental issues you may have had or social ones, because ultimately that all flows through into the operational productivity of the business and ultimately the financial results. And so you have to be honest. So I think, you know, that wrapped into not only the reporting but the consistent tone that executive take with engaging with the investment community about their approach and giving that regular and consistent update about these extra operational issues that they're contending with, I think are super important, and it just builds confidence that the executive team have got this in hand and are dealing with it appropriately.
Great, thank you.
Sorry,
is that Jay?
Yes, it is. I just want to say I fully agree with Chris, and I would simply say, you know, transparency is really what is needed. And I think if you look at the also the emergence of new technologies. You know, news travels much faster today than before, so you know you need to get ahead of these stories rather than playing catch up. I think that's the fundamental lesson. I think that pressure will only continue.
Great. Okay. Well, thank you. I'm very conscious, as I say, of time, so I think I will just try and wrap things up. But I just want to leave some key messages, I think, out there for us all. And I think the first one of those is that ESG is relevant to all E&R companies, energy and natural resources companies, irrespective of scale and irrespective of where they are in their business cycle. It's not too early to prepare your ESG story, and companies should not be afraid to talk to the journey that's they're on. And it's really all about having the right data to evidence your ESG performance. And then this is about managing one's ESG risk, but also seeing it as value creation and therefore business opportunity. And I think, put simply, ESG is good business. So to finalize, just like to thank our panelists, but also thank everyone else for attending and participating in this webinar today. Any questions we haven't picked up, we can try to do so either offline or perhaps in future webinars on this topic. We will circulate the slides from today's session, and do feel free to reach out to any of today's presenters on any follow-up points, but also to Fieldfisher for any legal issues associated with ESG. And do also keep a lookout for other events that we're running. And in the meantime, we also look forward to there being a time when we can welcome you back to a more physical type of seminar or other event in our office. And hopefully that time will come soon. So thank you all again, and goodbye.
Bye.